Hi everyone, welcome to my new video on Introduction to Investments. I'm Wildy Chia and welcome once again to my channel, and this is a very quick introduction to investments, and given that the topic is rather lengthy, I decided to break this into a few parts. So let me begin with this topic. Why is it that I would like to talk about this topic? Well, it's relevant to students who are taking the ACCA, those who are doing the Foundation in Financial Management, and as well as those who might be doing the F9 Financial Management paper. For those who happen to be doing a degree level qualification on investments, then this might be relevant to you. The intention of having this is to provide a quick revision for students who want to know something about investment, but they do not want to go through the full detail of everything on investments. So let's go through the scope. We're going to look firstly on what's the purpose of investments, and well, to some extent, how it's related to treasury management of a company. And following that is, what are the key considerations that have to be taken into account in making an investment decision. We all know that investments, if made properly, would result in possible capital returns as well as income returns. But what are the initial considerations? We'll look at that. And next, we'll look at the risks involved in making an investment decision. Right? No decision is without risk, and we need to know what kind of risks are involved. Finally, we'll look at what's the purpose of financial markets and how does it help, in making investment decisions. Right? So let's very quickly look at the purpose of investments. Now, the purpose of investments, well, to some people, they look at it as necessary, because it is necessary when businesses have excess funds. Right? It may not be businesses, but also individuals who happen to have excess funds. So when there is the presence of excess funds, then investments present a very useful way of recycling capital. Now, when we talk about excess funds, what are they? Well, there are two types of excess funds. One is what we term as temporary surplus, and the other being permanent surplus. A temporary surplus means that the surplus is available for short periods of time. Now, why would this be the case? Like, for instance, a customer who had happened to have paid earlier than expected, and then, and at the same time, suppliers are not asking for payment yet. That creates a moment of opportunity where this sum of money can be invested for a short period of time, just before the suppliers come to ask for payment, right? And of course, the earlier the customers pay up, then the greater this window of opportunity to invest. Now, this temporary surplus may also arise because of seasonal effects. When, let's say, for example, if you happen to be running a tour agency, then during certain parts of the year, you will tend to have greater cash flows due to the holiday season taking place. So then that results in a greater amount of cash flows being available, right? But that is temporary, because for the other parts of the year, the tour agency may not be having cash flows at all due to, most people travel only during the holiday seasons. Temporary surpluses may also arise from, reasons such as suppliers giving more credit terms. Suppliers giving more credit terms means that there is more time for any money collected earlier from customers to be invested elsewhere. A permanent surplus basically is any fund that's available for longer periods of time. Now, if you liked, it may be even infinity. Now, how would such a permanent surplus arise? Like, for example, selling off of a property. Now, the gains from the selling of a property will not have any immediate use, and probably may not have any use at all for a very long time to come. Now, then, what will we do with that surplus, since it's available for such a long period of time? Now, such surpluses can be invested for very long periods, like years, decades, and so on. Now, permanent surplus may also arise because of an IPO. A business that has done an initial public offering may find that it is flush with excess funds, so this excess funds can be put into very long-term use. Investments should be planned according to the type of surplus available. Obviously, it means that you have to understand what kind of surplus you have on hand and how much. So then investments can be planned according to, what kind of surplus is there and how long could you afford to wait before you need to take back, those surplus funds. Being able to recycle or plow back capital is important because it helps the business to achieve the ultimate goal of maximizing shareholder wealth. And that is especially true for companies, because companies are essentially owned by shareholders, and one of the goals of companies is to ensure that whatever money received from shareholders, companies try to maximize the return, and of course in the end maximize shareholder wealth. Now, investments are important, but one should not just jump into an investment because there's no other thing to do with money, right? We have to consider what are the key things important, right? In making an investment decision, liquidity is a very key consideration. Why? Because an investment can only be good, right? Especially if you are able to quickly liquidate or quickly sell off the investment and recover whatever money and even principal from the investment. Liquidity, if I can explain that in a few words, it refers to the ease of selling an investment, or if you like, security, without suffering from significant losses. So that is what we mean by liquidity. Now, liquidity is very important because if you happen to have an investment that costs a lot, yes, it might give you very good returns, but if you're not able to quickly sell it and recover whatever principal, then that isn't a very good investment, right? Because in times of cash shortages, you will not be able to liquidate and recover whatever principal that you have invested. So, for a business, it's important to time, the investment such that these investments are sufficiently liquid, and yet these investments are able to generate a reasonable amount of returns, right? Of course, not all investments are equally liquid. Certain investments are more liquid, some are less liquid. For instance, if you are holding something like a perpetual bond, liquidity may not be as good as, for example, a bank deposit. A bank deposit will have high amounts of liquidity, especially if the deposit is for short tenors, or if these deposits mature within short periods of time. So, again, a business needs to know whether it's investing temporary surpluses or whether they are investing their permanent surpluses. So these play a part in determining how much liquidity would the business desire, right, in the investment. Return may take two forms. It may take the form of capital returns as well as income returns. Now, capital returns are important because when you purchase an investment, you would obviously hope that the investment will appreciate in value, and when the asset or the security appreciates in value, we say that you have achieved capital returns. Now, capital returns could be achieved from stock investment, it can be achieved from bond investments. Now, for share investment, there are income returns. Income returns from shares could take the form of dividends, right? As long as you hold the shares of the company, you are entitled to dividends, as and when the company declares dividends. The same goes for bonds. For bond investments, there is also income returns. As a bond investor, you are entitled to interest returns, right? And these interest returns are income returns, right? Obviously, with high returns, that also means that there are some risks involved, right? Higher risk investments would obviously lead to higher returns. The greater the risk taken, the greater the amount of returns. So there is a very simple relationship between risk and return. And we describe this relationship in this way, right? There is an assumed linear relationship where the greater the risk, the greater the returns we assume, right? Because if there are no greater risks, why would what would justify the greater returns, right? Investments with high returns would normally involve certain amounts of risk, and reason being that perhaps there might be new industries being explored, and when you involve new industries where there are potential high returns, then therefore this leads to potentially higher risk. Okay, maturity. Maturity refers to how long an investment must be held before it can be liquidated, and then the principal can be recovered. Now, maturity varies depending on the type of investment. Obviously, if you're looking at bonds, then bonds may have varying lengths of maturity. Some bonds may mature within a year, some bonds may mature maybe in decades time, and some perhaps never even mature. We refer to that as irredeemables. Now, so depending, like if you are looking at, for example, deposits, then deposits might have very short maturity. Some may have very long lengths of maturity. The length of maturity may also affect the return on investment. Investments with long maturity would naturally result in higher amounts of return, right, coming from the investment. Risk. Now, risk is a very interesting concept. Now, to many lay persons, risk refers to the likelihood of losses. But the definition really is the variability of gains and losses. Right? So it's not just losses, but gains as well. Right? So investments that have this high level of risk would, as I mentioned just now, it will result in high amounts of return. Right? Risk may vary depending on what type of asset you're investing in. Certain things such as equity would involve more risk than bond investments. Certain investments are extremely high risk, such as futures and options. Futures and options involve more risk because there is a large amount of leverage involved, right? And then if you are trading currency may also involve large amounts of risk. Now, regardless, risk is quite different depending on the type of security that's being considered, right? Now, just to add, when you look at investments, typically in most investments, you could say that there are two types of risk, right? And the two types of risk, namely, are what we refer firstly as the unsystematic risk. Now, unsystematic risk is quite simple. Basically, it's a risk that can be reduced as the business or the individual increases the number of investments that he has, right? And the greater the number of investments that an individual has or a business has, that basically spreads the risk and reduces the amount of unsystematic risk. So, if you like to put it in another way, basically it means as you have more investments, you are spreading your eggs over more baskets, right? Now, however, regardless of the type of the number of investments that you have, there is always some extent of risk that cannot be eliminated. We term that as the systematic risk. Systematic risk is completely unavoidable, right? Because it affects, it may arise from civil war, riots, disasters, and these are completely unavoidable. So, however much you spread your risk, right, of your portfolio, it is impossible to avoid systematic risk. Okay, so that covers this. So basically, we have these four considerations that are involved in assessing investments. Right, that's liquidity, return, maturity, and risk. Of course, depending on where you read about this, some textbooks may have different other angles of looking at such considerations. All right. Okay. Financial markets. Now you are going to invest your money, and why could you have access to all these investments. You are interested to invest in stocks, but how could you actually have access to the opportunity to invest in stocks? That's where we have this thing, which is what we call financial markets. Now, financial markets present and serve a very important function. That is, it provides liquidity. Like for example, yourself, you bought a stock, right? How do you know that you are able to sell the stock? Because you are able to go to the financial market and sell it to another willing party, right? Markets provide this thing known as liquidity. With liquidity, it makes it attractive, right? It makes an investment attractive. It makes a security attractive to investors. It makes it easy for investors to trade securities, right? And of course, as I mentioned just now, it makes a security attractive, right? So certain assets tend to be exceptionally liquid, and one of them is, of course, gold. Gold is highly liquid. Like for example, you have bought gold jewelry from another shop maybe a day ago, but then if you need the money today, it's possible for you to go to any pawn shops, or perhaps see anyone who is interested. You might just offer them the gold jewelry, right? And you should be able to sell this gold jewelry with very little losses, and you should be able to sell all this gold jewelry quite readily. Gold is a traditional investment asset, and it's highly liquid because if you talk to anyone, gold is actually as good as cash. Maybe not literally, but gold is, to a large extent considered as good as cash, right? So you might have realized why older people like to keep gold, because the fact is that gold is highly liquid, right? But not all items are highly liquid. Certain things such as bond investments may not be as liquid. Certain things such as bank fixed deposit for fixed tenor, such fixed deposits may not be readily liquid. So financial markets exist for the trading of different types of assets, including shares, bonds, commercial paper, certificates of deposit, options, futures, and so on and so forth. So, depending on the needs of the business. So, if the business wishes to invest in stocks, then there is a financial market for stocks. If the business wishes to engage in the trading of more risky options, yes, it could. These are all available and accessible. Okay, regardless of whichever investments, all such investment securities have to be first issued as new first, right? When these are issued new for the first time, right, for the very first time, we say that these are issued in a primary market. But the moment when these securities are already issued, they are then traded in secondary markets. Now, secondary markets are important because, it provides liquidity. It makes it possible for investors to trade their investments and also to balance their investment portfolios to match their risk appetites. So investors who might be willing to take more risk are able to purchase or acquire more risky assets, while those who are more risk averse, they might choose to acquire assets that are lower risk and try to maybe have lesser amounts of what you call the high risk assets in their portfolio. Securities have liquidity as a result of the presence of secondary market, and this makes them attractive to investors. Investors will be willing to invest in such assets that have liquidity, which is why, if you think of the stocks of a listed company and a company that isn't listed, you find that investors who tend to invest in shares of listed companies for the very simple fact that shares of listed companies have greater liquidity than those that are not listed, right? Planning of investment should be aligned with the business's liquidity requirements, and should also be planned according to the treasury management strategy of a company, right? So certain companies might have a very conservative treasury strategy, so such companies may wish to hold large amounts of cash instead of being aggressively investing in equity markets and also the bond markets. In any case, any investment decision made should not significantly deviate from the core business activities. Right? Why? Because investments is a way of recycling capital, right? And recycling of capital shouldn't be mixed with the core business activities, right? Take for example, if you're operating a hotel business, then excess money used to invest can be used to invest in stocks, bonds, and so on. But these should not be so significant to the point where these totally and materially deviate from the core business of the hotel, right? But again, it depends on the business. Usually in today's economic environment, you find that businesses may have many different business activities, and they may not necessarily stick to the core business which they used to have previously, right? But in any case, it is always ideal that whichever things that the business invests in, it shouldn't deviate too much, right? It should not run contrary to the core direction of the business over the long term, right? So that is the part 1 of my introduction to investments. I'm Wildy Chia, and thank you for watching. I'll be coming out with part 2 of the video series, and this part 2 of the video series will go on to explain what are the characteristics of the different type of investments, right? And hopefully that would complete the complete understanding of this very simple topic of investments, and this is on an introduction level. Thank you for watching, and I hope that you have a great day. Look forward to hearing from you.